and let's talk about de-risking strategies. What if you've invested in a particular investment instrument, for a long-term goal, and now you are nearing that particular goal, and what kind of a strategy you should be opting for? I have with me Arun Kumar, Head of Research, Funds India. Arun, hi, good evening, and welcome to the show. A very interesting discussion because, often we talk about strategizing for a particular financial goal, but then when it comes to sort of de-risking or taking a new approach when you are approaching that particular financial goal in terms of your time frame, what should be the strategy? So let's start simple. Why is de-risking often ignored or postponed by even well-informed investors? Because they tend to forget about it. They see good amount of returns coming up, so they don't take the initiative to maybe reallocate or re-strategize.
Yeah. So thanks, Kavita, for having me on the show. So broadly, if you look at, any of us would suggest that if you're coming into equities, you need to have a longer time frame. Now, what is the logic behind it is a fairly simple, straightforward thing that there will always be intermittent declines. And if you have a long enough time frame, you can account for the declines and the recovery period, and inevitably market tends to go up. So it's almost like a 3 steps forward, 1 step back kind of a behavior that equity markets exhibit. So if you're a long-term investor and probably if you've invested for 7-10 years, you've already had good returns. But the unfortunate part is that as and when you need the money, say let's say you need the money in the next 3 years, now you don't have the long term is already done. So you're already done with 13 years and probably you're looking at the next 3-5 years to take your money off. This is where it gets very risky, because if let's say there is a fall like COVID, because COVID fall just happened in a matter of 2 months and nobody could predict. And by the end of 2 months, you were almost down 40%. And now again, recently we saw a 10-15% correction in large caps. And there was almost a 20-25% correction. And it was very, very fast. So it is very, very hard to say when you will meet with a large correction. And unfortunately, say if I have only 1 more year left and there is a large 40% correction that happens like COVID, and in the next 6 months, my portfolio is down. So I'm just left praying because in the next 6 months, I need the money. So the key idea of de-risking is that, hey, you've made money over a long period of time. So whenever your goal is reaching, so probably you take a 2-3 year time frame before your goal. That's the time where you start reducing your equity allocation, because it's very hard to predict when the markets can fall. So the idea is, even if the market falls, I should be able to move out of equities gradually and move into a safer asset class like debt. So the reason why most people don't do it is you have seen good returns, and most of us think of it as a compromise on returns, that if I invest in equities till the end, I can take all the juice out of equities. But again, as if something, if you're met unfortunately with a large fall, then it can work on the reverse. So I think broadly you should look at de-risking strategy as an insurance, where the idea is to protect and give you peace of mind.
Sure. So Arun, in a nutshell, it has to be a plan that you need to set right from the beginning of your investment. Also, I want to understand what is that golden rule or the golden time frame? 2 to 3 years of time frame, or do you think that really varies? You said it is insurance, but then when do you start implementing, or when do you activate this particular plan?
So the broad idea is very simple, that whatever is your equity allocation, you need to move it to a safer asset class like debt. Now, level 1, you can keep either a cutoff saying that if my goal, I have already reached, say, 80 to 90% of my goal, or I am very close, say I have another 2-3 years left for my goal. This is usually a good trigger where you start thinking of moving your equity allocation to debt. Now, level 2 is, should I do it one shot? I think it's better to do it gradually. So you can use a simple system like STP, where once you automate, so calculate whatever is the amount that is in equities. And then if you have 3 more years, then spread it across 3 years on a monthly basis, and then set up an STP into a corresponding debt fund. And then this can go on. And let's say worst case, you meet with immediately there is a sharp correction in the 3rd year. I mean, you've started, and in the next year there is a very sharp correction, but again you have another 2 more years left. So if the market falls by more than 15%, you can pause your STPs, because again, if the market is fallen, you don't want to take out your money when in a fallen market, but you have enough time to recover. So let's say over a period of year and a half, it recovers. Mostly markets tend to unless a very, very large fall, mostly markets tend to recover in a very short span of 6 months to 1 year. And even in a large fall, more often than not, 1 to 2 year is more than enough. But in very, very rare cases, it's gone even up to 5 years. But broadly, for most of us, 1 to 2 year is a more than enough time frame for recovering from majority of the falls. So putting all these three things together, start 2 to 3 years before or when you have already reached 80 to 90% of your goal. Second point is you do an STP for 2 years or 3 years. The third point is if at all there is a sharp market fall during that period, you pause your STP and again restart it once the market again recovers back. So I think if you can do these three, and again, as Kavita, as you told, now does it exactly have to be 2 3 years? I think while 2 3 years is a good time frame to do it, I think you should start annually reviewing your goals 5 years back, so that you can also look at how close you are to the goal. Are you still is the goal flexible, and do you have some leeway with the goal? And the third most important, where is the market? If the market is in very extreme bubble kind of a condition, then probably you might want to do it a little ahead of time. But otherwise, broadly, while you should monitor it starting from 5 years before the goal. Generally, a good thumb rule would be to start doing the STP 2 to 3 years before the goal. So this is how I would approach this.
All right. One more thing, considering some real life scenarios now, should the approach differ between fixed and flexible goals? For example, a child's education fee versus buying a second home. How do we prioritize this?
So the good part of a flexible goal is, see, ultimately here the catch is on the time. Because if my time is fixed, the point is if there is a market correction, I will be forced to sell, because if it is my child's education fees, then I don't have a choice. And if the market is down 40 or 30%, then I will have to take the loss. So we don't want to be a forced seller. Now, in case of a non-flexible goal, you need to be a lot more conservative. So you might need to start 3 years ahead, and then you need to move from equity to debt. But let's say if it is a flexible goal where you can extend the time frame, maybe you can start 2 years ahead. And as a second level, instead of moving it into debt, you can move from equity to one level lower to probably a hybrid fund. Maybe a category like balanced advantage funds can be a good choice, where you are saying, I don't want to fully go into debt, because that I might leave some bit of upside which is possible on equities. But BAF is a midway category where, based on valuations, they will take a call on how much to go into equity. So I think if you have a flexible goal, then you can, instead of 3 years, you can start 2 years before your goal. And two, you can, instead of moving into debt, you can move into BAF. And worst case, there is a correction, you extend your time frame by 1 or 2 years, and you should be through. So this is how I would adjust for a flexible timeline goal.
Sure. Arun, you've also spoken about automating discipline. Can setting STP trigger at 80-90% of goal funding, that can help remove emotion from the equation? Can this be taken as a call?
Yes, STP is very, very critical, because if you try to do it manually, because there is always some bad news happening, or at some point in time you might get overexcited. So there is a probability that you might either do too much of selling ahead of time, or you might leave it. You might not sell at all for some point in time, because you suddenly start assuming that there is a lot of good news and the market. So you start inadvertently trying to time the market. And so I think if you automate this whole process, then you take the emotions out of it. So I think STP would be the right choice to de-risk your portfolio as and when you are reaching your goals.
Last question, in your view, what's the best way to review and adjust de-risking strategy in the final 3 to 5 years of a goal?
See, broadly, you start 5 years before in terms of monitoring it. So you ask the question saying, how close am I to goal? And with the broad return expectation of your portfolio, will you be able to reach it? Now, if not, then you will have to supplement with some more savings from your side. And the second point is you also need to bring in the markets into context, because there will be periods like 2008 where valuations are very high. The market has run up much ahead of the last 5-7 year earnings growth. And again, the FII flows would be crazy, DII flows would be crazy. There'll be a lot of IPOs, there'll be a lot of promoters selling. The sentiments would be very, very, almost everybody would be greedy. And there'll be a lot of anecdotal saying. So if the market is very, very expensive, then you may want to take some, I mean, because then obviously your returns would have also been much higher and you would have reached your, I mean, the percentage of goal reach would be a lot ahead of time. So there you can start de-risking a lot earlier. But this is a very rare case, probably might happen 5% of the times on a 10-20 year basis. So for all the remaining 95% of the cases, you can comfortably start at a 3 to 2 years before your goal. So this is level one. And how do you make this better? While planning itself, you can. So let's say I have a 15-year goal of say saving up 50 lakhs. Now most of us plan for exactly 15 years, but if you can, instead of 15 years, you plan for 13 years to achieve that, then accordingly you might have to save a little extra, but that is still fine. But you can build that margin of 2 years when you are starting your plan. So this is level one. And level two, as I told, for flexible goals, you can use BAF as an additional option if you don't want to go too conservative into debt. And apart from that, I think broadly this, if you can automate it and take your emotions out of it, we should be through. And the key thing is not to look at it as a loss of returns. It is purely an insurance strategy. So you don't know. Sometimes it might work out in favor, sometimes it might not. But don't treat it as a return maximizing. Don't look at it as return maximizing. It is more of return preservation.
All right, Arun, we do have a lot many aspects to cover as far as this topic is concerned, but then my time is up. Thank you so much for taking time out today and helping our viewers. It's a very crucial aspect of their financial strategy. Thank you.
Thanks. Bye.
All right, let's move on. And the last leg of the show, which is viewer queries, I have with me Pankaj Matpal, who is the MD of Apna Money Managers. Pankaj, hi, good evening. Welcome to the show.